Hello everyone and welcome to a new video about reading price action. In this video we're going to talk about chart patterns. That's basically the following step from the ability to read each candle in a candlestick chart that we've seen in the previous video. So what we're going to talk about in detail. What is a chart pattern? And why patterns are useful for trading, and a few examples of the most important chart patterns that receive a name, like flags, wedges, cup and handles, heads and shoulders. How to identify patterns on the chart, and basically that's it. So first of all, what is a chart pattern? You can think about a chart pattern as a sequence of candles on a candlestick chart that can provide some kind of information, and it's usually as a pattern is easy to recognize, and thus it's going to be watched by many traders. That's the key idea. And the ideal pattern is usually very clean. It means that the features identifying that pattern are very easy to recognize, whereas in real situations it is not always the case, and some patterns can be a bit messy. Why are these useful? There are two reasons basically. The first one is that the pattern itself tells a story about what the price action was during a given time frame. No? So considering the whole sequence of candles forming the pattern, you get an idea of who was in control, or if there was someone in control, like the buyers or the sellers, or if they were struggling to find the balance, if the stock is consolidating or it's about to move forward in one direction or another. The second reason is that because of this information, many traders use chart patterns as reference points for their trades, and it becomes basically a self-fulfilling prophecy, because if everyone is looking for something, then when that something happens, they're going to do something else. When that happens, it's likely that the price is going to go in that direction that they were expecting, because everyone moved considering that situation and based their trading upon that. So let's go in a bit of detail with a few chart patterns. There are several, but again, I don't think, especially as a beginner, you don't need to know every single chart pattern. What matters the most is that you get an idea, and that you focus on those that are actually more used, usually. Also because if they are more used, more traders are going to actually implement them in their trading and consider them for their trades, giving them a higher chance of actually providing useful information. The easiest and most common that I can think about is the flag pattern, which is basically highlighted in here in these two colors, this purple and magenta lines. Basically we have a pole in that's an extension of one or more candles. This is one, but they could be many candles, one after the other, that extends the price over, for example, the EMAs in this case, or anywhere over where it was trading in the previous candles. And then we have the flag itself in magenta, which is an area of consolidation, which usually shouldn't go too deep along the pole. Otherwise it becomes something else. Ideally, let's say this is already a kind of limit, with the bottom part of the flag in this area almost halfway along the pole, but that's still okay. The consolidation can be one or more candles. It depends on several things, but what matters is that there is no weird shapes after this consolidation. And with weird shapes, I mean candles shooting higher or lower. It must be a consolidation phase where the price stays almost in the same place. Clearly, depending on whether the pole is a green candle or a red candle, so coming from here, it goes down and then consolidates here, it can be a bullish or bearish flag pattern. And in this case, it means the buyers are in control. With the red one, the sellers are in control. And the whole idea is that the price after the flag is going to continue in that direction, most likely. So it's usually a continuation pattern. Let's see, and let's call it an ideal, just to give a reference, and what identifies an ideal flag pattern. And in this case, you see that the pole should be quite bigger than the previous price action. Like here, you see these are very tiny candles, then there is this huge extension upwards, which is important. And the flag should be tiny. Now the consolidation phase should be tiny compared to the pole, and not too far from the top of the pole, which in this case is here. The pullback, which is formed by this candle, only this candle in this case, should be ideally showing higher lows. So if you get more candles, like let's say this candle here is smaller and doesn't go over the high of this one, so it would be still part of the flag pattern. The ideal thing is that this low here is lower than this low here. An example of a not ideal flag pattern, and it's easy to understand why it's not an ideal flag pattern, at least not on the bull side. We're going to see on the bear side. Here we have a series of candles going high, which from here would be the pole, let's say, but and then we have this little flag here formed by this candle that is consolidating above you up. But you can see that the price before is very messy, big candles. The pole itself, let's say the extension, is not really an extension in this case, it's just trending higher. Okay, so it's not parting from the moving averages, and the consolidation, although being small in range compared to the extension move to the upside, is still because of there is no steep enough in the pole, doesn't resolve in an actual flag pattern. This candle breaks out and then fails. This instead is a flag pattern on the other side, on the bear side. You have an extension candle which is pretty big compared to these candles here, definitely going one direction. Then you have this consolidation phase, which is not ideal because you have a higher high compared to the one of the previous candle. Ideally, you would like to have it, in this case, for a bearish flag pattern, to have it in this direction, so trending downwards, and then it breaks out and continues to the downside. Another important pattern is the wedge. Wedges show a consolidation of price action in around an area. This could be a symmetrical wedge, like in this case, where the two lines identifying the wedge, so the higher resistance, which is in this case is descending, and the lower support, which in this case is ascending, are basically with the same inclination, same slope, let's say. Whereas there can be other wedges where, like for example, the support is flat and the descending resistance is steeper, or several differences. Sometimes they get different name, pendant, different names, but basically they are all wedges, some way or another. Some are more bullish, some are more bearish, but the main idea is that you have a consolidation phase that lasts for quite a few candles, and then only at some point ideally when it's approaching the tip of the wedge, the price breaks in one direction, and it does clearly, like really shooting far away from the wedge itself. In this case, it means that the buyers and the sellers have found somewhat of an equilibrium, and they're still trying to move the price up or down, but no one is actually succeeding, since the lows get ideally higher and the highs get ideally lower. And so at some point this wedge should resolve in one direction or another. The difficult part is that it's hard to predict which way it's going to go, and when the move happens, sometimes it's very strong, and you need to be quite fast to catch it. Sometimes it resists during the cancel, it shoots, it tries, breaks, taps down again the wedge, confirms that the wedge is holding, and shoot higher, or the downside does the same, like shoots below, tests the upper resistance at this point, which is no longer support of the wedge, and then cracks down. Again, what does a wedge pattern, an ideal wedge pattern, look compared to the not ideal one? Ideally, the support breaks only once at the breakdown, or resistance breaks only once again at the breakout. So there are not many candles going much higher or lower, let's say, than resistance and support before actually the price decides which way to go. The consolidation phase should last quite a lot, so very tiny wedges, I don't know, like only a few candles, are more in the context, are valid in the context of a flag, but as wedges themselves is not ideal. It's better if the consolidation phase lasts enough, because it builds the position, allows the traders to build their position during this phase. Those who want to go short will likely sell higher and start to build their short position. Those who want to go long are going to buy in this area and the lows, building their position. And when the price breaks in one direction or another, the people on the opposite side will have either to cover or buy or sell at the bid, and thus fuel the move that will separate the price from the wedge. In this case, we see a not ideal wedge because until here it was fine, no? Top, bottom, they don't break, they define the wedge. Clearly you need at least 2 candles to define a line, the descending line here, and you're going to get tops. Here on the lows it's more confirmed, the support, because you can see there is 1, 2, 3 candles, almost 4, and then later on 5, 6, 7, 8 candles holding the support line. Whereas the resistance is not that clear. It breaks, comes down, breaks, comes down. Here it's broken completely, and it only finds a way upwards in the end after struggling, even when coming out finally at the tip. But you can see it resolves at almost near the tip of the wedge. So it's still the not ideal move here could be because it's still too early. You see here the wedge is still very wide, especially compared to the size of these candles, whereas here the candles are getting smaller and smaller and smaller. At some point the price has to decide which way to go. But as I said, not ideal wedges are very tiny in terms of duration, and the support and resistance lines break more often than not. That's not ideal. Now we're going to analyze the cup and handles and the heads and shoulders patterns. This is a reverse cup and handle, and you can see the cup, which is the higher, let's say in this case, or lower if it is an actual cup and handle valley, no? In this case, in this case, a mountain, and then a small one. Ideally, you see a flat bottom or a flat top in the case of the cup and handle, and the idea is that the price tries to go higher here, comes back to a low, tries again to lift from this low, but doesn't manage to go any higher than let's say a third of the whole extension of this mountain, and it's likely that at this point the price is going to go down. It won't last. No, it won't continue to go higher, and it's what happens here. So as I said, there is an attempt to reverse the price here, not from coming from the low in this case, trying to go higher. It fails, and then it continues. Ideally, the first curl is well defined. What I mean is that the price actually forms this first steep, in this case move to the upside, then a sort of consolidation, doesn't actually manage to go higher from here. It comes back down pretty steep, taps ideally the same level of the low before, making this flat bottom, but it can be a bit tilted, let's say, and then tries again to break out from here, to reverse, doesn't make it, cracks the low here again and falls. And as I said, ideally there must be a consolidation here in these areas here. So it's more like a U shape and not a V shape, okay? Like in this case, this is not ideal, even though it works, like as you can see, it actually does a breakout here after this, breaking this flat top. But it's not ideal because there is this first steep move, which is okay. But then it almost immediately reverses, now making like a W shape here instead of this U. Comes back down, goes up again. Then there is this long consolidation phase, very choppy, very messy, almost deep into the cup, let's say. No, this candle here is almost this halfway this range of this cup here, and yeah, it moves upwards, but then it's a more messy. It's still valid, but it's messier. Head and shoulders, instead clearly a reversal pattern, because it shows that you have a move higher, then the price action makes ideally a higher low compared from where it started, then another move higher, not much bigger usually than the first shoulder, but definitely going higher than this price area here. Consolidates for a relatively long period. Ideally, the shoulders and the head should have the same time span. Then it makes another higher low. So in this case, it's still trending higher, but it makes another shoulder, which is lower than the top here. And this ideally shows that the price is already in the backside of the move. So a reversal is about to happen. The price in this case came up, it's most likely to go down rather than shooting higher. Clearly, this is always a matter of chances. It can be the other way around. And then, as I said, it's a sign that we are on the backside of the move. Ideally, as I said before, the shoulders and the head, the head is in purple, the shoulders are in this magenta color, should have about the same time span. This is almost on the edge of what is considered valid, but I always try to find a real example for these slides rather than making a fake chart with the ideal scenario, because the ideal scenario never happens. It's always some kind of a compromise, no? But this is quite good. And not ideal, instead, is something like this. And this is not a real, basically, head and shoulder, because you can see, yes, there is the time frame is almost okay. No, you have this duration of the shoulder is good compared to the head and the other shoulder, but what messes up the chart is that this shoulder is almost higher than the price here is almost higher as compared to the top here. It's very near. It could be basically still trending up. Just to get more into the action itself, or how you should look for these patterns in your trading and in watching the charts. The ideal thing is that the pattern should be obvious. If you have to look really hard to find them, then it means that they're going to be less effective, because other people may struggle to find them, and their only use is that if many traders are going to use them to judge their setup, where's the entry, their exit, their stop, that's the only way that the pattern is going to be useful. So if you really have to look hard and force them, it's harder that they will work. If you see that they don't work on a specific stock for any reason, even if there are many traders watching the stock moving, but you see that 3 flags out of 4 fail to become a continuation, then stop trading them. In that case, in that occasion, yeah, maybe the 4th will be the right one, but again, it's more like people are going to watch what happened in the past and how the pattern resolved, and base their decision on it. So you will never know, but ideally the best flags are those that keep happening over and over and over again on a stock. Same goes for the wedges or cup and handles and so on. The patterns work because of the herd mentality, and that's why they become often a self-fulfilling prophecy, but that's the only reason, not the only, that's one of the 2 reasons why these patterns are useful. So keep in mind that yes, they describe price action, so clearly they describe what's going on in the market, but also they are used by the traders. So again, make sure you are watching them on a stock that's actually in play, that people are watching, because a pattern on a stock that's left alone by itself to its own is hardly going to be valid in any way. They need volume in any case. When you use patterns for your trading, it's a good idea to identify not only the trigger, so where you actually should enter, but also when they have failed, and the pattern is ruined and it's no longer valid. So always imagine how ideal is that pattern in that moment, understand whether it's a good idea to keep trading this or not. And I think that's it for today, and I hope you find it useful. And if you have any questions, as usual, make sure to comment down below. I'll try to answer your questions, or if you have topics you would like me to talk about. I have many videos planned for the future, but clearly they take time to build, so I will do them little by little, but keep posting and commenting your questions, so that I can also get an idea what are the questions to answer, or try to answer at least. if you like this video and you think it's going to be useful for other people, share it or subscribe. It's going to happen the algorithm to allow other people to find it. So thanks everyone. See you and bye bye.